Hi students, so this is class number 10 for this CMA and financial management. We are in chapter number 1, decision making tools, and in decision making tools for last few classes we were discussing on almost all the illustrations given in the study material, and after all the illustrations some 44 additional problems has been prescribed in the book. So last class we have started discussing and we have discussed almost 9 problems, and in this class we are going to discuss problem number 10 to problem number 16. So there are total 44 problems, okay, and all those 44 problems are from marginal costing mainly. So there is a high chance that 2 or maximum 3 questions will be hit from this chapter. So, and there is a significant amount of probability that these 3 problems will be out of this 44 problems. Same problem, yes, there is high chance. Similar problem, or also there is a high chance. Okay, there will not be some new type of problem that is created. Only the existing problem, maybe they will change the name of the company or change the figures little bit here and there. Okay, so guys, all the very best. Let's go into today's class. So this is the problem number 1. Yes Limited furnishes you the following information relating to half year ended 30th June 2015. So half year is ending at June, so which means this company follows maybe calendar year for the financial accounting. Okay, so what is given in the question? Fixed expenses is given, sales value is given, profit is given. Okay, so which means this is sufficient detail. Okay, so sales value 1,50,000 is given. Sales value minus variable cost will give you the contribution minus fixed cost will give you the profit. So here you have profit of 30,000 and 45,000 of fixed expenses. So which means 30,000 plus 45,000, what will be the contribution will be 75,000, and 75,000 of contribution, sales value of 1,50,000. So what will be the variable cost? 1,50,000 minus 75,000 is equal to 75,000 will be the variable cost. So which means with the available details we can able to plot the statement of marginal account. So maybe statement of marginal costing itself. Okay, so that much of detail from these 3 detail we can also calculate the variable cost. We can also calculate the contribution, and contribution is there, sales is there. Yes, we can also calculate the PV ratio also. So guys, whenever the marginal problem question comes, you have to have all this in your mind: fixed cost, contribution, variable cost, net profit, and PV ratio. What is break even point? Break even point is equal to fixed cost divided by PV ratio. And what is break even point? Sales. Okay, what is margin of safety? All this stuff should come in your mind, and all this should be arranged in a neat fashion. Whatever asked in the question, you can deliver it, but all this has to come in your mind, so that when you are answering some match the following or fill in the blanks, even at that time all this stuffs will come into your mind, and that will make you answer correctly. Okay, so yes, let's read out the question. During the second half of the year, the company has projected a loss of 10,000 rupees. So the loss is 10,000 in the second half of the year. Okay, calculate the break-even point and margin of safety for 6 months ending. So for the first half of the year, we have to find the break-even point. For break-even point, we need the PV ratio. As I said you earlier, yes, we can calculate the PV ratio. So PV ratio, if you calculate, it is contribution divided by sales. 50% is the PV ratio. And what is the break-even point? Break-even point is fixed cost. Yes, we have the fixed cost. 45,000 divided by 50% PV ratio. So break-even point is 90,000. Do we have margin of safety? What is margin of safety? If your sales is higher than the break-even point sales, then you have positively made some profit. At that time, margin of safety is positive. If your sales is less than the break-even point sales, then margin of safety is negative, which means margin of safety has to be positive. Only then you can make a positive profit, or else you will make loss. In the second half of the year you are made loss, which means margin of safety has little bit reduced. Okay, so we will come to that later. Okay, so margin of safety is 1,50,000 your sales. Break even point is 90,000. So 1,50,000 minus 90,000, 60,000 is the margin of safety. Expected sales volume for the second half of the year, assuming the PV ratio, fixed expenses remain constant. So which means the PV ratio of the first half of the year is going to be the PV ratio of the second half of the year. Similarly, fixed cost of the first half of the year, which is 45,000, the same 45,000 is the fixed cost for the second half of the year also. So what we have the fixed cost. Okay, also we have the PV ratio. What we have to find? We have to find the sales. What more detail we have? We have loss of 10,000 rupees. So if the loss is 10,000, which means minus 10,000, okay, what will be the contribution? Contribution is nothing but profit or loss, okay, plus profit or loss plus fixed cost is going to be contribution, because contribution minus fixed cost is equal to profit. So contribution is equal to profit plus fixed cost. Okay, so fixed cost is 45,000, loss of 10,000. So 45,000 minus 10,000 is equal to 35,000 will be the contribution. So you have the contribution, which is 35,000, and now, okay, and we know very well what is PV ratio. It is otherwise called as contribution margin, or otherwise called as contribution divided by sales. Okay, for contribution divided by sales. Now you have contribution margin, or otherwise called as PV ratio. So sales is equal to contribution divided by PV ratio. This is the second formula. Okay, sales is equal to contribution divided by PV ratio. It is the same formula. Okay. So contribution is 35,000 as we calculated, divided by PV ratio of 50%. Sales is going to be 70,000. Okay. So for the first first half of the year, 1,50,000 sales. For the second half of the year, 70,000 sales. That's a drastic reduction in the sales has happened. That's why the loss has been projected for the second quarter. Okay. So sales volume, yes, we have found. Next, what is the margin of what is the break-even point and margin of safety for the whole year? Okay. Okay, so yes, we can find it. PV ratio, first half also same, second half also same. For the whole year also it's going to be same. 50% is the PV ratio for the whole of the year. No issue. Then break even point. What is break even point? Is equal to fixed cost divided by PV ratio. What is fixed cost for the whole of the financial year? First half 45,000. Second half there is no change in the fixed cost, which means second half also 45,000. 45,000 plus 45,000, 90,000 is the full year fixed cost. So 90,000 divided by 50% is going to be the break even point sales. Next, margin of safety. If it is any margin of safety is there, for that you need to know the sales. Okay, for the first half of the year, 1,50,000 is the sales. For the second half of the year, 70,000 is the sales. 1,50,000 plus 70,000 is 2,20,000 is the full year sales, and break even point sales is 1,80,000. So how much we are safe? 2,20,000 minus 1,80,000 is 40,000. So margin of safety is 40,000. So guys, this is a consolidated problem in which you have everything about marginal costing. This one problem will be useful for you to answer your objective type question, will be helpful match the following, or any 2 marks question or 4 marks question. So many stuffs are hidden in this guys. Also, if you read theory, which I will circulate separately in the Telegram group, okay, that also will be easy to understand for you if you answer this type of problem. Watch the video once again, or rewind and watch. Okay, and you will work out it separately. Okay, while you are working out, you will have thousands of questions, and after that also see the video. If you are unable to get answer out of it, please drop your comment. I'm there to answer you. Okay, I'm moving to the next. Okay, so for the following is a statement of Radical company for the month of June. Okay, so there is a L product is there, M products is there, the total is there. Okay, sales, variable cost, contribution is given, fixed cost is given as a company as a whole. Fixed cost is not divided into two products, fixed cost is given as a company as a whole. Okay, so contribution 48,000, in which 36,000 goes towards the fixed cost, 12,000 is the net income. Okay, you are required to compute the PV ratio. PV ratio, yes, we can easily find. Contribution divided by sales is the PV ratio. So contribution, yes, we have 18,000 divided by sales of 60,000. Yes, we can find the PV ratio for L. We can find the PV ratio for M. We can find the PV ratio for whole of the company also with the help of total. Okay, so PV ratio for each of the product, and then compute PV ratio, break even point, net profit for the following assumptions. Okay, following assumptions is given. Sales revenue is divided 60%, 40%. So which means they are asking you to maintain the sales revenue at 1,20,000 as given in the question. 1,20,000 is given. Maintain sales as 1,20,000, but divide the sales into the product, 60% for L, 40% for M. Okay, so 60% for L, 60% of 1,20,000 is 72,000. Okay, so guys, there is a typo error here. The first column is product L, the next product is product M. Okay, the first is product L and product M. I have done a typo error here. So 60% is to 40%, sales is divided. Yes, so this is a very simple problem, but very simple mistake the students makes. Okay, which is the mistake is the calculation of variable cost. Okay, what student usually do is, okay, for the 72,000 sales, they just go here, take 42,000 variable cost, put the 42,000 here, calculate the contribution and PV ratio, and they proceed. But the result is the person who is going to evaluate your question paper will strike out the complete problem. Okay, we should not end up there. Okay, so that we have to be clear. If 60,000 is a sales, 42,000 is a variable cost. Okay, if 72,000 is a sales, so variable cost should be different. This is the first level of thinking you have to do. Okay, so variable cost cannot be 42,000. Variable cost will be something different. So what is that? Okay, for 60,000 it is 42,000. For 72,000 it's how much? So 42,000 divided by 60,000 multiplied by 72,000. Okay, so 42,000 is a variable cost for 60,000. So 42,000 out of 60k. So 60k is the sales, out of which 42k goes for variable cost, and the remaining will be sitting for contribution. Correct na? So if the full circle is sales, half of the circle is variable cost, then remaining half of the circle is going to be your contribution, right? Because sales minus variable cost is contribution. Same way here I am just putting variable cost divided by my sales multiplied by current sales. How much is that? How much is the current sales? It is 72,000. So multiplied by 72,000 so that I can find the variable cost for the 72,000 sales. Okay, so by applying that formula I have found the variable cost for 72,000 sales on pro rata basis. Okay, apply to 50,400. So you have found this, and same methodology you can apply to find the variable cost of product L. So now you have sales, now you have variable cost. If you reduce it, you can find the say contribution divided by sales, you can find the PV ratio. When you have the PV ratio, you can find the PV ratio for the whole company. For company as a whole, you have the fixed cost divided by PV ratio, you can find the break even point, and you have the fixed cost also, you have the company's total contribution also. Contribution minus fixed cost, you can also find the net profit, because it is asked to find the PV ratio, then break even point, then net profit also. Okay, so guys, hope I'm very clear. Calculation of variable cost is very critical for this problem. If you go wrong there, your problem is at risk. Okay, your 8 marks is at risk. Okay, so guys, be very careful in this problem. It looks like very simple problem, very simple mistake, khatam ho gaya. Okay, so so guys, next problem is instead of 60-40 bifurcate into 40-60. Yes, we can do that also. It is very similar. I'm challenging you, you do this on your yourself and match this. Here the case 2 table I have put, match the figures with this. It is, if it is matching, all the very best guys, you have done your job. Okay, so let me move to the next problem. So this is problem number 12. Accelerate Company Limited manufactures and sells 4 type of products under the brand name A, B, C, D. 4 types of products. Sales mix is given. So what is sales mix? They will complicate this by this kind of statement. It is nothing but the percentage of sales divided between these products. Okay, so 33 1 by 3, 41 2 by 3, 16 2 by 3, 8 1 by 3. So you guys are going to become ICWA. So they are just checking if you guys have really studied mathematics. So that's why they have given this complex rational number. Okay, we can convert this into a simple numerical number. Okay, so no worries. Next, they have given the budgeted sales 60,000 per month. They have given operating cost also. They have given how much percentage operating variable cost. Okay, 60 percentage of selling is variable cost for A. 68 percentage is variable in nature for B. 80 percentage is variable in nature for C. Okay, and then fixed cost also they have given. Calculate the break even point for the on overall basis. Okay, as we discussed in the previous problem, company as a whole break even point has to be found. Okay, so not product specific break even point, they are asking for company as a whole. Okay, yes, and then they are asking to find the break even point if sales mix is changed as follows. For a different sales mix, now the sales mix is very complicated, we will try to convert that into a simple numerical number. Okay, so 33 1 by 3 is nothing but 33 plus 1 by 3. Okay, which is nothing but 33 plus 1/3 of 34. Okay, so what is 1/3? 1/3 or 1 by 3 is nothing but 0.333. Okay, add that to 33, it becomes 33.33. So 33 1 by 3 percentage is nothing but 33.33 percentage. Similarly, 41 2 by 3 is nothing but 41.67 percentage. Okay, so apply the same math, guys. Convert A, B, C, D, whatever is the percentage, convert that into the numerical formula. If you add this, it will come to 100%, right? Because sales of the whole company is divided in percentage. How much percentage? A, B, C, D. Okay, so total will come to 100%. Now you have the sales of 60,000. Apply this percentage and divide and find the sales of the respective product. Variable cost, can you find it? Yes, we have already given 60% of sales is variable cost for product A. So for product A, 60% of 20,000 is going to be 12,000 is the variable cost. Same way, apply this percentage on the sales that we have calculated now and find the variable cost. And the sales is there, variable cost is there, you can find the contribution also, contribution for all the product also you can find. However, we are going to find the break even point on overall basis only. So the variable cost, okay, so now you can total the variable cost. Total variable cost will come to 39,000. So contribution can be found sales minus variable cost. Contribution divided by sales, PV ratio can be found. Fixed cost 14,700, yes we have. Fixed cost divided by PV ratio is nothing but the break even point, which is 42,000. And if you want to find the net profit also, no issue. 21,000 contribution we have minus fixed cost of 14,700, 6,300 is the net profit. Okay, that sounds very simple problem. Okay, so where we can go wrong in understanding this complex rational number, you may go wrong. The second where you can go wrong is applying this 60% for finding the variable cost, because only if you find product wise variable cost, you can total it and find the company as a whole variable cost. Then only you can find the company as a whole contribution, PV ratio and break even point on overall basis. Okay, that's how this variable cost percentage has been useful for us. It is not a not required data, it is a required data. Only then you can find the answer for this. Okay, so guys, if this percentage of sales mix is changed as given in the question 25 40 35, I am very sure you can solve that. Okay, please do the math in your book side by side. Okay, and then you just check with this table if all the numbers are matching. Okay, so your question is your book is having a problem 13 in which instead of giving sales as a cumulative number, per unit sales is given, and variable cost instead of percentage per unit is given. So apply the same logic and find the answer. And if you have any doubts on that, please put a comment. I'm there to support you guys. So moving to the next problem. Yeah. So this is the problem number 14. The following particulars are extracted from the records of the company. Okay, so sales is given, it is in rupees and 100, so it is 100 rupee per unit. Okay, so per unit is also given here. Consumption of material 2 kg 3 kg of material consumption is given. Just for the namesake, they would have not given this data. If kg is given, okay, we have discussed this in one of our previous problem called limiting factor problem. Watch all the videos orderly, guys, then only the formulas that we are discussing in this class will you can understand, because it would be a derivative of all our previous classes. I hope you are seeing everything in a orderly fashion. That's why I put the video in with the top sheet class 1, class 2, class 3, because you should not miss the order. Because I would have I have explained elaborately the formulas in the last class, and I would give only the cut short explanation in this class. Okay, so please watch the videos in order. So consumption of material is in kg. Okay, so we have seen a limiting factor problem where some resources to the company may be limited. Okay, there will be a limited availability of manpower, or limited availability of material, or limited availability of electricity or something. Okay, so so your aim is to make a maximum profit with the available critical resource. That will be the decision making point. This problem is also one such problem. Okay, so that's why they have given material in kg. Usually material cost per unit they will give, but here material in kg they have given. How much kg of material is required? Material cost also they have given per unit. Wages cost also they have given. Expenses cost also. Machine hours they have given. Okay, so which means machine hours also may be critical for them. Okay, because you can see practically also when corona period has come, company can operate with only this much of labor, this much time only they can operate, because after that transportation will not be available, so the employees cannot go home easily. So because they have, so 10 hours production will be cut short into 6 hours production, so which means machine hours has become a constraint over there, which means that has become a limited factor over there. Okay, so same way 30% attendance is only available as per government regulation during the COVID times. At that time, labor hour itself is a limiting factor. So guys, because of the environment or because of the market, there will be lot of pressure for the company. Any new limiting factors will come. Financial person has to identify this and what is the effect of limiting factor on the profitability. Okay, we have to use the resource so judicially so that with maximum profit can be made with the help of available resource. That is called limiting factor decision making. Okay, let's dive into the problem. So overhead expenses, so fixed overheads per unit is given. Usually fixed overheads will not be given as per unit, but here they have given per unit. Okay, so variable cost is also given, per variable overhead is also given per unit. Okay, direct wages per hour, so per hour is given, direct wages per hour is 5 rupees. So wage cost also they have given, so total wage cost also they have given. Per hour what is the rate is also given, which means number of man hours used or direct wage hours, that also we can find. Okay, total wages cost divided by per unit wage, that also we can find. Comment on the profitability of each product. So guys, why I'm saying stories in between the reading the question is that's the way you have to read the question, so that all the data sits in your mind, and while doing the problem you will look for appropriate data, pull from the question and create the answer for it, or else you will forget the portion of question itself. Okay, so read it like a story, imagine it. Okay, so have visualize it. Okay, so that you can apply the same, and you will, and even though even if you have forgot to see the part B of the question also, your mind will say go and see if the question is complete or something else is there. Okay, so that's the reason behind it. So let's go to that. A comment on the profitability of each product, product A, product B. We have to comment on the profitability. Okay, both use the same raw material. When total sales potential in unit is limited, total sales potential in value is limited. Okay, so what is that? So social sales potential, sales potential means sales revenue. Sales revenue is selling price multiplied by the quantity. So units is limited, so sales quantity is limited. With limited quantity, whatever is the sales, maximum profitability, we have to comment on the profitability. Maximum profitability has to be achieved, which means okay, when you go by unit wise, your PV ratio or contribution margin should be higher. When the units is limited, higher contribution margin can fetch you higher profit. And when what is value is limited, value is sales revenue. When sales revenue itself is limited, sales revenue itself is limited, inside that sales revenue, how much is the contribution? That's the physical contribution. Okay, what is the physical contribution? And that will be the decision making factor to comment on the profitability, which product A is profitable or product B is profitable. We have to do the decision making in this problem. There are 4 scenarios that is given. In this 4 scenario, which is the best product, that is what is our decision making to be done here. Okay, so here I am going to put the marginal costing statement. Sales, yes, it is given in the question. Material is given, direct wages is given, direct expenses is given, variable overheads is given. Okay, we can reduce all this variable cost and you can find the contribution per unit. Okay, contribution per unit can be found. PV ratio is contribution divided by sales. Yes, PV ratio can also be found. Okay, so total sales potential, if value wise, if you see contribution per unit, whichever is higher, that will be the best product. If you see contribution per unit is also higher for product B. Okay, it's 55 for A and 69 for B, it is higher for product B. PV ratio is also higher for product B. It will not be always happen, guys. It will not always happen, because PV ratio is contribution per unit divided by selling price per unit. It will not happen always, but this time surprisingly for product B, contribution per unit is also higher than product A. PV ratio is also higher than product A. So in this question here there is no problem. So for value wise, when the value is higher, how much margin is higher will give you the better product. So contribution per unit is the contribution per unit is the margin. Contribution is the margin. So product B is having, so product B. So unit wise, if you see PV ratio, how much higher number of unit, higher number of volume. So PV ratio is a mix of factor of contribution and volume. So contribution, volume, both are mixed into, so that's why it is called profit volume ratio. So when unit wise decision making has to be done, PV ratio has to be bring in, but surprisingly here PV ratio of product B is better than product A. So product B is the decision. Next is raw material is in short supply. Here is where is the real decision making comes in. Okay, what is the kg of material used? 2 kg and 3 kg. It is given in the question, 2 kg and 3 kg. Now contribution per unit of product we have, contribution per kg of material has to be found. So 55 rupees is the contribution earned by spending 2 kg of raw material. So 55 divided by 2, 27.5 is the contribution per kg of raw material. Similarly, 69 contribution from 3 kg of raw material. So 69 divided by 3, 23 is the contribution earned per kg of raw material. So if we see product A is having the higher contribution per kg of raw material, so that is the better. Okay, next production capacity is the limiting factor. Machine hours, they have put in the bracket machine hours because there is a confusion sitting in the problem. There is a wages cost is also given, and wage cost is also given, wage rate per hour is also given. Wage cost divided by wage rate per hour, we can find the wage hours or man hours. Okay, we can find the man hours. Okay, if they have put man hours here, we should have used man hours as a limiting factor. However, they have given machine hours as the limiting factor. So machine hours they have given here 3 hours and 2 hours. So take the machine hours here, 3 hours and 2 hours. As we found contribution per kg of raw material, same way we have to find contribution per machine hour. So contribution is 55 rupees and 69 rupees. 55 divided by 3 machine hours is 18.3 per machine hour. Similarly, 69 divided by 2 machine hour is 34.5 rupees of contribution per machine hour. So in this case, product B has higher contribution per machine hour. So product B is the decision making. Okay. So guys, hope I have made this very clear. Please rewind and watch this video. All the very best, guys. Oh, there is one more question that is lying. Let me go to the next slide. Okay, so the next question is, assuming raw material is the key factor, availability of which is 10,000 kg. So you have 10,000 kg of raw material and each product cannot be sold more than 3,500 units, which means product A can be sold maximum 3,500 only. Product B can be sold maximum 3,500 only. Find out the product mix which can yield the maximum profit. Which can yield the maximum profit? Material is a limiting factor. So per kg of material, maximum contribution whichever makes, that will be our top priority. So 10,000 kg of material you have, and contribution per kg of material which we already found 27.5 and 23. So A is better. A is having higher contribution per kg of material. So the first priority is to make product A and then we have to make the product B. Okay, so material required per unit is 2 kg and 3 kg. So 3,500 units we can make our product A, 3,500 units we can make product B. Product A is having higher contribution per kg of material. So we can make product A first. 3,500 of product A will need, each unit needs 2 kg of material. So 3,500 into 2, 7,000 kg of material can be used to produce 3,500 units of product A. Okay, so product A is completed. Maximum 3,500 units we have completed. What we have left out with 10,000 kg material was there. 7,000 we have consumed for making A. We are left out with 3,000 for making the product B. In 3,000, how much units of product B we can make? For making 1 unit of product B, you need 3 kg of material. So for 3,000 kg of material, 3,000 divided by 3 kg per unit is going to be 1,000 units of product B you can make. So you can make 1,000 units of product B. So 3,500 units of product A, 1,000 units of product B is the. So your question may also ask, what is the profit, maximum profit? In that case, you can put the marginal cost statement. per unit rates is given in the question. Multiply the per unit rates with this production quantity 3,500 and 1,000 and you can find. Okay, variable cost is also given. Okay. So put a column product A, product B, multiply this 3,500 of product A multiplied by the sales per unit is given, material per unit is given, direct wages multiply by 3,500 and all the variable cost, and then you can find the contribution of product A, and then okay, stop with the contribution of product A. Next go to the product B. How much product B we are making? 1,000 units of product B we are making, multiplied by the sales per unit, find the sales, multiply by all the variable cost, find the variable cost, find the contribution of product B. Product A contribution plus product B contribution will be the sum total contribution, and then reduce the fixed cost from that. Here is where the twist. How you will reduce the fixed cost? That also we can find here. Here they have given maximum 3,500 units, and 3,500 units can be made of product A and product B. So fixed cost per unit only they have given. So multiplied by the capacity. So 5 rupee per unit multiplied by 3,500 is the maximum capacity, and 10 rupee per unit multiplied by 3,500 is the maximum capacity will give you the fixed cost. So fixed cost is not variable with per unit level. However, a company what they usually do, no, they will see the previous year's P&L, and in the P&L the rent or employees administration employees salary, all those kinds are fixed in nature, because they will continue to incur even if they make the product, even if they don't make the product, they will continue to pay. Such expenses is called fixed cost. For example, if you are not making the product, will you consume material? No. That's why it's called variable, because whenever you make the product only, you will do such expenses. For example, direct labor or direct material or variable overheads, all those things will be incurred only when you are making the product. That's why it is called variable. And even when your production shop is not running, even when you are not making the product, at that time also you will be paying the rent for the company, right? If it is a leased building, lease rent, or if it is a rented building, you will pay the rent, right? So it is a fixed expenses. So fixed expenses will be derived from last term's financial statement. For example, 1 lakh is the fixed cost that you have derived from the previous year. On per unit level, you have to have for decision making, right? Because you are going to fix a price for your product. In that price, you will know the variable cost, you know the contribution, whether your contribution is sufficient for taking the fixed cost or not, you have to check, right? For that you need to have the fixed cost per unit. Per unit fixed cost usually will be found with the help of capacity. Capacity will not be changing immediately. Production will be changing, sales will be changing, but capacity will be constant. So that's why fixed cost is taken with a reference which is a lump sum figure like 1 lakh or 2 lakh and divided by the capacity. Per unit fixed cost is taken, and if your contribution what you are calculating is higher than your fixed cost per unit, okay, then which means you will be making money in the long run. That's how your sales price will be fixed in the company when you are actually working. If you have any doubts on this, guys, please rewind and see, and even still if you have doubt, you post a comment on this, I will reply you, I am there for you. Okay, so in that way you have found the fixed cost also. Previously we have found the total contribution of product A, product B. Okay, you can reduce the fixed cost from the contribution and you can find the net profit for the company if the question asks so. Here they have not asked the profit. If they have asked also, we can find that. Okay, so yes guys, so that is my agenda for the day. So problem number 15 and 16 is exactly same as what we have solved in our class number 9 and class number 10. Please work on that, and if you have any doubts, please post a comment on that, guys. All the very best. Thank you.